Rod Kusin and Spoon for Risk for August 26th, 2016. All times on the chart are Central Standard Time. We're going to do a review of today's activity just to show you how some of the indicators that we use were very effective in allowing us to understand where this market was headed today. We start off with this daily profile as well as a composite profile shown here. Now, if you've looked at any of our videos in recent past, we've been talking about this 2159.50 point of control down here, and fully expecting to have that hit, which we see finally was hit today. Dropped a little bit below that as well. Nothing unusual about that. But that number has been a solid number now for quite some time. And so this drop down to that level was really very compelling, very compelling. Now, the real question was what was going to happen when good old Yellen gets to yelling. And you saw what happened right at 9 o'clock. The market no sooner than heard her voice than the market drops like a rock. Now it shot back up. We had some other positive economic reports come out earlier today, but those economic discussions soon obliterated any rally that had ensued, and we dropped down to new lows, hitting that point of control that we've been talking about previously. Now, the real question was, where was this market going to go as it moved up? There's various ways, again, that we could have looked at this. And when you run this calculation, which we've talked about previously this week, a simple price extension, 3-point price extension, this low, this high, down to this low, generates a price extension. So all we need to do now is just show you how that looks. Okay. And there you have it. It shot all the way up to the 200% line. Okay. Shot all the way up. And then after going up to the 138, we had this drop, okay, which took place, right there at the time, the 9 o'clock hour when, or 10 o'clock Eastern, when Yellen got to talking and dropped the market, and then up it went thereafter. Now let's also take a look at how this market dropped and how we could have known a little bit more about where this was headed. Now, keeping in mind, we already had the 2159.50 level established. But now look at the IB. When you run an IB, an initial balance calculation, you see the 1.5 standard deviation line comes right down to that line and takes a bounce. The YM went all the way down to 2 standard deviations, and then it bounced. Okay, so that IB calculation, very, very effective. And if you don't know, IB projections are accurate over 80% In other words, the probability that the market will move either up or down to at least the first standard deviation line is better than 80%. In other words, 4 out of 5 days a week, that's going to happen. That's what the statistics show, and we've kept track. Now, incidentally, the worst day, the most unlikely day, even though it's still over 80%, but the most unlikely day is a Thursday. And you can see what happened on Thursday. Didn't quite make it. But that aside, here's your IB. All you had to do was just have it running, and you had a pretty good idea as to what was going to happen once this market started to tank. Because when you started looking at the premium, you knew this was coming back. There's no doubt about that. Premium indicated on that drop that this market would fall. So let's take a look at the premium. Now, a real simple look at our first low pivot that took us down to negative 237. You could see that we were just way, way below that when this market dropped. So there was no doubt about the fact that this was going to be coming back down. Now, in all fairness, what about the move back up? That requires a bit more discussion. But if you just look at the placement of this initial threshold, and we'll show you for various reasons why we wouldn't hold to this all day long. But if we just run this out to the right, we were way, way below that line after the market came down initially, and it was way below it when we finally hit the low over here. And there was good reason for us to recalculate this threshold later on. And you can see this just doesn't even make any sense. It almost looks like a fair value line. Okay, so we'll talk about how we recalculate that in just a second. But you'll also notice that from this initial pivot high here, right as this market began to drop, we were below that particular threshold, and the market really took a dive. And then she bounced. Now, let's talk about the rest of the day. The low of the premium at the time of this low pivot was negative 301. All right, and of course that was considerably lower than the initial threshold that we had just discussed. But you can see that even if we use this lower threshold associated with this low here on the premium, when this market began to tank, it was even dropping further. So again, no doubt about the fact that this low was not the low. You knew that the premium was telling you this is going to continue to move down. So that price would have to be tested, and of course, as we know, it was, and we dropped even further. But very interesting, from this threshold of negative 306, we just run that out for the rest of the day, and notice where we are when we hit the low. Here's the low, okay, and we're above that threshold. Okay, we're above that threshold, and up we go. Very interesting. Now, are we coming back down? Yeah, we're going to be coming back down. But that's the low side, and just that simple threshold at 306 was enough to hold true through the entire course of the day. But the real question that we have is, what about the upper thresholds? This is a little bit more challenging. So let's come back here and talk about that. Okay, when this market rallied up, all right, it moved up to a lower high on the premium, yes, but a much higher high on the premium than was associated with this first pivot point here. This is at negative 0.97. This threshold is even higher. We're not showing it right now, but let's just do the easiest way. We'll just put it to you this way with a when the market hit that high, the premium high was at negative 8.3. Negative 8.3. Okay, so that's even higher, of course, than the negative 0.97. What does that suggest? It suggests next week's going to be pretty volatile, and once again, we're going to be rallying back up there according to the premium. Nevertheless, this was a pretty substantial drop, but right down to the point of control again, and then she started moving back up. But we think we'll probably move back down, test that level, and then start running back up. Say on Monday. So watch out on Monday. Monday could be really volatile because that high of the premium is kind of that's equal. That's just as compelling up here as it is down here, in the sense that this low on the premium really forecasted the continued drop. But having just moved up to a 200% extension, that's very difficult to exceed easily. And although that did in fact take place on the YM, the ES only ran up to 200%, and then she just bounced right off of that, came back down. So where did we set the threshold here? Now, that's a good question. In a market that's selling off, as it is here, the methodology used for establishing the premium thresholds is different. What we like to think, and of course this is all theory. This is theory. This is based on a hypothesis and very close long-term observations. But what we do is we look for higher readings on the premium as the market drops. So we're just going to give you a sample of what that looks like here. All right, so what we're doing here is checking out the threshold of the premium on these lower highs, the lower high pivots of the ES. So this first threshold brings us to negative 1.14. So it's a point of reference. Then we have another lower high, just slightly. This was at 86.25. Now we're at 86. And we've got a higher threshold. If we choose to use that, all right, and we project this out, you can see that based on that value, when we pushed up to this price here, it's predictive of a further move up, which we see happen until all of a sudden the premium really drops and we get this corresponding drop again. But then as the market recovers a bit, we get another big spike up, exceeding that on the premium. And so that price is tested, and then it drops way down again, and we see this corresponding drop. Moving this forward. Okay. Another big move up, and that price has to be tested. And as it is, all right, premium drops, and we get this higher pivot threshold. If you just compare it, what's happening here to the thresholds, 146, 135, 128. All right, so it's stepping up as we're moving up. That's to be expected. But if we use that as a threshold instead of 104, you notice that as the market tests that same price area right in here, we can easily see how the premium is dropping way below that level, and then finally, it gives it up, and we see this substantial drop. But you can see that on the premium. Very nice. Now, what is the threshold that we really want to work with? That's a little more difficult to say. I think 104 is too high, personally. 128, probably in my estimation, the most predictable. We had this little move up, all right? We had a little bit of a move up, okay? And this became the last pivot. We didn't really go any higher than that when we saw the premium now beginning to drop. So I'd like to use that as a threshold. But you might be inclined to use negative 148. Now look, notice what happens if you do. All right. We'll get rid of this line. And as we move forward and we see the market dropping, the spikes that came up above the 128 level, we did see the market continue to move a little higher until it dropped below that level. So you saw it here. So that validates that 128 level. Okay, and then we were below both lines when we hit this pivot, and she dropped even more. Now it popped up again, and we tested those highs, and then it dropped again. But after that, we didn't see much at all. But when it did occur, when we did get spikes above the the higher of the two lines here, as you can see, it was to a degree predictive, and then all of this was just smoke because that market came right back down. Now let's shrink this up so we can see more particularly where we stand. Way below both lines on all of these pivot highs, way above, until right in here. Then we shoot up once again. And having shot up above this lower line, the question is, was it enough to become predictive? And that's a little bit of the difficulty that we have in running these thresholds. This could, if you use the lower line as your point of reference, you could say that, well, yeah, then it's predictive, and it turns out to be right, because we did rally back up, and we did exceed that point. But if we don't use it, okay, and we use the if we don't use the lower line, we use the higher line. Notice what happens later on in the day. All right, we still get this move up until finally right here we get our first real spike, which incidentally is it's right there, and this happens so frequently. It just happens so frequently. Right when that same price is hit, if the market's going to continue to move, we frequently get another new spike on the premium, and that happens, right in here, and then we continue to move up. Okay, so right in here, premium starts to spike up again until here, and then drops below both lines, and we get the final drop one more time. Okay, so it's a little hard to say, and therefore we use more than one threshold lines at times, because there's no way to be absolutely sure which of the thresholds is going to work. Now, in hindsight, it makes it a little easier, but these big spikes become we can be fairly confident of the predicted value there, as these spikes, especially above these particular levels here, were significant, and the market did come back. So that's our analysis for the day. I'm Rod Koosman, Spoonman for Risk.